Hi everyone, and welcome to this month's webinar. Now, this is all about what to expect as a first-time investor. So we're going to run through everything from start to finish in terms of what you guys should be doing, what you guys should be researching, what due diligence you should do, what other agents you should phone, because we always say to people, look, do your own due diligence and phone around, don't just take our word for it, what kind of research you should be doing. So, and then at the end, we'll have a sort of question and answer session. There's two ways to do this. You should have a bar at the top or sometimes at the bottom of your screen where you can either chat to us or do a Q&A or like a question and answer session. So at the end of this presentation, we'll sort of do that, and then we can all sort of jump in. You can ask any questions you want, guys, no problem. So look, without further ado, let's head in. So first of all, what should you expect as a first-time investor? Well, importantly, you've got to know the market that you're about to invest in. There's certain things that you need to know before buying. And in terms of that, that's going to range everything from the area to the pros and the cons, which we'll run through in a minute. But importantly, to make a success of it, you've got to work out meticulously what your income and what your growth is potentially going to be. Income is a bit easier to say it's going to be that because you're going to have tools in terms of your Rightmove and Zoopla in terms of how to know what income you're going to get. Growth is a little bit more speculative because, of course, we don't have that magical crystal ball where we know exactly what we're going to get. But based on history, we can have a rough idea of what we're going to be doing over the next 12, 24 months. Then once you've understood all those factors, we then need to decide in terms of the area that you're going to go into and then choose your specific property, one that suits you, whether that be one that suits you from an income perspective or one that suits you from a budget perspective. And we then come down to the process once you reserve, exchange, complete, how everything works. And of course, then we head on to the last step, which is like the rental side. So let's talk about what you need to know before buying. Again, like any investment vehicle, the first thing you've got to do is research the ins and outs of the markets. Yes, you need to use a professional, but of course, let's be frank about it. A professional also has an ulterior motive. They want to get you involved in the market because they get paid in it, just like we do. That's how we earn our money, just like every other agent will do. So that doesn't mean that they'll tell mistruths, but what they will do is there's things that you will have to research and there's things that you'll have to do just to double check everything that the agent is saying. But however, really a good agent will provide proof. If they're saying that there's one particular area that's better than another, they should actually provide you with hard proof of that rather than just something that is, said in a whim on the phone call. And again, you need to know the downsides as well, because if you can live with the downsides, then you can start to build up your knowledge from there. If you look at your downsides and you're uncomfortable with your downsides, then my advice is don't touch property at all. It's as simple, straightforward as that. So let's start looking at the downsides. First of all, you're going to need a large deposit. When you invest into other investment vehicles, whether that be premium bonds or stocks, shares, or you put money in an ISA, cash ISA, or savings accounts, you don't need a hefty deposit. You can do that with maybe several hundreds of pounds. But with property, you can't. You need a decent sized deposit. Now, you can get lower than this, but typically I'd say you need at least 30 to 40,000 before breaking into the main market. And what I mean by that is a city centre, a major city centre, whether that be Manchester or Liverpool or Leeds or Nottingham, you probably need 30 to 40,000 pounds. So that's the first downside, is that you're going to need a larger deposit than you would if you were investing in maybe another investment vehicle. That's the first thing. Secondly, you're going to have to qualify for a buy-to-let mortgage. Now, they're not just going to simply go and value your property that you're buying and say, well, this is going to give you X amount rent, no problem, you can afford this. What they're going to do is they're going to do a stress test on you. So for example, what if the rental property was empty? How many months would go by until it's going to be a bit painful for you? So for example, if it was empty for a month, can you still afford it on your personal income? No problem. 2 months, 3 months, and so on. It will get to a point where, of course, you won't be able to just keep going on paying for a property that's empty, but the banks want to know how long you can do this for without rent coming in. So they will all have their own independent stress tests. Some, depending on your areas, will have a lower stress test than others. Some areas, especially if you head into secondary cities, they may want you to prove 3 to 6 months of the void period before they actually start to lend. So again, you'll have to qualify for that. So it's probably worth speaking to a mortgage broker before you actually delve into purchasing the property. You don't need to get the mortgage at that stage, especially if you're buying off plan, but it's worth having that conversation first, without a doubt. Again, Property is not a quick return. One aspect of property is that you're not going to have something where you get an instant flip overnight. You're not going to have something, again, like the stock market. Although we've seen great dips, we've seen big increases where potentially you can have comfortably 20-30% in a really short period of time, within 6 months or a year. You don't get that in property. You're not going to suddenly make 30-40% in the property market over a period of 6 months to a year. There is a flip side to that. There's an advantage of that, but as I say, from a downside perspective, don't expect quick returns. We say to everyone, you've got to be looking at least medium term to longer term to maximize your returns on the property market. Again, like I said here, it's not a quick buck. It's not one of those where you can quickly flip. In my opinion, gone are the days where you can go and buy a property, do it up, and within a few months flip it for a number of reasons. First of all, typically you have to hold a property for at least 6 months before selling it onto a mortgage buyer, because banks want to see that it's been owned for 6 months prior. Secondly, the cost of materials has gone up so much that typically it's very difficult now to buy something of a cheap price, do it up for cheap enough, and then flip it on, and there still be enough margin in it. So again, gone are the days where you can make a quick buck. People that can still are developers out there where they're buying their products in economies of scale, but typically not for the average investor. Again, the market might not be liquid. So one thing that we have to look at is when you go and sell stocks and shares, especially in the top trading market like the FTSE 100, again, it's going to be a liquid market typically. You've got market makers who will buy your shares or make a market in your shares. But again, if you get to the property market, it might not be liquid. If you're buying it in areas which don't have much movement, then again, it could be months before you sell your property. All you have to do is go and do a quick search on Rightmove in certain areas, and you can see things that are on there from this time last year. However, that's why we say you've got to use an advisor, because in the best areas, you will no doubt have a more of a liquid market, especially in city centres, where properties are actually only on the market for 3 or 4 weeks before they get snapped up. But again, always got to bear in mind, if you need that money quick, and this is why we say as you get older, again, I know with my own family, as they start to get older and they head into their latter years, they're always worried about, they need money for, could be anything, could be, rainy day, operation, anything like that. With property, it's not one that you can just liquidate within a day. And again, there are a lot of initial taxes, whether that be stamp duty that you've got to pay, and this is a lot more for overseas. So you get an extra bit of stamp duty if you're buying a second home or a buy-to-let. And again, for overseas clients, they've got another 2% on top of that as well. So they're all the downsides. Now, again, if you can cope with those and you're comfortable with those, then my advice is, look, then we move on to the upsides, and if you fully understand them, then we can start to move things on from there. So in terms of the upsides, well, because it isn't a liquid market, and what I mean by that is because it isn't something that's quickly traded every day, it means that the flip side of that is it's stable. It's a very stable market. Of course, we've had downturns. We've seen the late 80s where it fell, and that was because of sky high interest rates. And again, we saw in 2008-9 where the property market fell. But again, they only fell sort of 15%. It wasn't something that just halved overnight. So the property market is a very stable asset, and it is seen as a safe asset. We haven't had the Lehman Brothers scenario where it's been seen as a safe asset and gone to zero. Typically, the property market is always worth something. And the reality is even if you've got a property that you've purchased and it dips, well, you're still getting the income on that. So if you've got a tenant in there, you're still getting the income. So the reality is even if the property market dips, well, you can wait until it goes back up again, but you are still getting your income. That's important as well. Leverage. Now, for me, this is the biggest one of all. The fact you can leverage in the property market is a huge, huge asset, because the reality is if you've got £50,000 and you go and put that £50,000 into a savings account, an ISA or stock market or wherever it may be, that's it. You're making money on the back of that £50,000. Whereas if you invest it in the property market, you're making your income and your growth on that £50,000, but actually you can borrow potentially up to an extra 150,000. So altogether, you've got your 50,000 that you've invested, plus you've got 150,000 that you've leveraged, that you've borrowed. And yes, you might have a mortgage on that of 3%, for example. But the reality is if you're making 5% income on that, plus 5% growth, well, you're actually still net 7% increase up on £150,000, which is not yours. So you're actually making money on the whole 200,000 rather than just the 50. So typically it will work out far bigger gains than you can if you didn't leverage. And again, people always need a place to live. So this is another big thing that whereas stocks and shares, they go in and out of fashion. For example, we've seen Netflix recently, which was really popular during lockdown. Then suddenly we've seen it fall away. Again, these are fashions. The reality is people need a property. People need somewhere to live. So the reality is that if you're buying a good enough area, you're always going to have that rental market to rely on. And again, on average, we've looked at it over the last 40, 50 years. On average, you're going to generate a higher consistent return in the property market than the majority other, if not all the other investments out there. So that's something that you've got to take into consideration. Again, there's options for you as well. You can let out on short-term let, such as Airbnb, that can generate circa sort of like 10% net income, which we're doing for clients at the moment. And you can also do a traditional let, again, where you've got sort of a normal 12-month buy-to-let where you're generating 4 to 5% income. So the reality is that if you look at those positives and you look at the negatives and you think, you know what, I can cope with those and I'm happy to move ahead, then you need to start looking at areas. Now, this is one where you do need to do some due diligence and you do need to speak to your brokers on. A lot of people, they make the mistake initially of looking local. Why? Because they know the area, they know where the local schools are, the library, the transportation. But the reality is the majority of people, unless you're living in a buy-to-let hotspot, are actually only going to make 2 or 3% income at best. Probably less than that in terms of the growth side of things, even though we had a bumper year last year. But if you're buying in a buy-to-let hotspot, like Manchester, like Liverpool, Liverpool was up over 10% last year in terms of growth. Manchester was up over 8% in terms of growth, plus 5-6% income on top of that. You're pushing 15% plus in terms of Liverpool and Manchester. So the reality is that it's probably best buying outside your area. Now, you might turn around and say, well, I can't manage it, I can't run it, I can't go and see it. But why would you want to do that anyway? It literally costs the price of a coffee a day. So if you go and spend money buying a coffee a day, that is the cost of you getting it managed for you. And the management agent or the letting agent will get tenants in, they will vet it. You won't have to deal with any of the issues. They will take care of that for you. And again, we offer that service, but you don't have to use us. There are plenty of management agents out there, because a lot of clients say, well, what if you're not here anymore? Well, there's so many management agents in the local areas that you just want to be focusing on this as an investment perspective. So buy in the areas that are going to give you the best income and use a professional to do their job. We always say the same thing, is you shouldn't be doing a job that you're not the professional at. So let a management agent do that. You wouldn't go in and start plumbing or doing the electrics. Use a plumber to do the plumbing, use an electrician to do the electrics. Always use a professional for their job. It's far more economically viable, and you might think you're saving money doing it yourself, but you're going to cost yourself time and money in the long run. So use a professional, use a management agent, and buy in the best areas for the best return. That's what we always say about the area. Now, once you've chosen the area, and you'll speak to a lot of different agents who have different slants on the areas, but as I say, we always look to back it up with facts in terms of where have been the good areas, what have we been recommending over the last decade. Once you've chosen the area, we can now start to narrow down into the actual property and the development. Now, we have multiple in Liverpool, we have multiple in Manchester, multiple in Birmingham and London as well. But the reality is at the moment, what we will do is we will assess you. We will do what's called a discovery call at the beginning. We will make sure that that call is all about you, why you're looking to buy. People have different aspirations. Some people want to buy for pension in 10, 15 years. Some people for kids, grandkids, university funds, whatever it may be. So what we do is we find out what you're looking for, what your budget is. And then what we say is, look, let's go away, we'll have a look at some ideas, and then we jump on like a Zoom call or Google Hangout or some form of video call just to get a better understanding of you and make sure you understand the areas that we're looking at. And then we can start to narrow down developments that fit within your budget and fit within your time frame along with your aspirations. Now, once we've done that, what we can then do is we can then start to dig a little deeper in the development. We can talk about whether it's ready yet, whether it's not ready, whether it's tenanted, not tenanted, why this development is for you, and we can start to go through the specifics of each development. So as I say, the checklist is what we will do as well, is we will look at areas within areas. So it's all well and good saying, well, Manchester's a great place to buy it. But the reality is that you don't want to buy in Deansgate in Manchester because it's already had its growth. So there are areas within Manchester that we need to look at. So what we will do is we will find the pockets that are still fantastic for income and fantastic for growth. So we always say, look for areas within areas. What does your budget allow for? There's no point in us recommending a £400,000 or £500,000 property if your budget is 150. So we will look at things that are good enough. What we won't do is if you've got 150,000, for example, we won't say, well, go and buy this because it's cheaper or it's run down. That's not what we're looking for. We're still looking for a great property. And if we feel that your budget doesn't stretch for one particular area, no problem. We'll look at other areas which can still give you the great return. But as I say, it's always best to go for a decent property, not the highest end. You don't want some luxury property that is too expensive for the area, but you don't want something that's really run down. And the reality is, if you get something that's run down, the tenants that you get in may not be the ideal tenants. They might not pay on time. They might not take care of the property. You want the ideal demographic that rents your property out. So again, we'll talk about, is the development ready now? Is it tenanted? Is it off plan? And we'll talk about the pros and cons of each of those as well, because there are pros of off plan where you can get it below market value, but the negatives about off plan is there may be delays. You may have issues with developers getting on site, which we've seen with a couple of developments over the last few years. So there are pros and cons to each of those. And again, the advantage of having something tenanted is you know straight away what your income is. The disadvantage is you're going to probably pay a bit more of a premium for having something that's ready now and already tenanted. And again, are there any risks associated with the development? For example, some developments before, they've had cladding. So the reality is that what does that mean for you moving forward? Do they still have cladding on? Does that mean you can't get a mortgage? So there are many things out there that we have to look at first before we make that recommendation. But we will run through every single upside and every single downside before we make that committed recommendation. And again, the last thing that we'll do is we'll look at what your returns are going to be, or likely returns. We can never guarantee anything. For example, even if it's tenanted, the tenant might move out in 6 months. So we will look at what the market's doing, if rent's increasing in the area, which the majority of areas it is. So what are your likely returns going to be? And of course, we'll also look at the likely growth, and we'll look at what Knight Frank have said, we'll look at Savills, we'll look at what we're saying, and we'll take a blended average of those. And of course, we're going to come out somewhere pretty close to that in terms of the growth side as well. And again, can you let it out short term? If you can, again, it gives you just a few more options. There are some developments where you can't. It explicitly says in the lease that you cannot let this out short term. So if you can't, you can only do that on a traditional let. But these are all things that we need to consider before we make that recommendation and before you choose that particular development. And then, of course, once you're happy with that development and you're content and you think this is the development for me, we'll then pick a particular unit. Again, the units might vary between £15,000 to £20,000 in there, depending on size and orientation and height in the building. So what we'll do is we'll pick your unit within your budget. We'll make sure it's got a great letting potential, and then we can take it on to the next step. And if you're happy with all that, you can then move forward and make the reservation. Now, the reservation is really straightforward. It's all done online. We've got a really straightforward form, but what I would say is this, is the majority of reservations, not all, but the majority are non-refundable fees. That's something that you need to take into consideration. The reason why it's done like that is because years ago, when they were all fully refundable, what essentially happened is people were reserving 10 or 15 and then exchanging on 5 or 6. And then it was ruining the market for other people who wanted to get on board. So what they did is they started to make the fees non-refundable. There are occasions when we can make it refundable. For example, when a client's looking to get commitment on a mortgage prior, we can do things like that. We'll negotiate with the developer for you. But take into consideration the majority of the time, and it says this on the form, the fee's non-refundable. So what I would say is make sure that you're fully committed before putting that reservation fee down. So as I say, with a form, it's all done online. It's all done in what's called DocuSign. You can sign that electronically. And the fee can be anything between £1,000 to £5,000, depending on where the developer sets it. And again, 9 times out of 10, that particular fee comes off your overall balance. There's only 1 or 2 developments that we've done in the last decade where we've had to charge a fee on top because we don't get paid by the developer. But typically the developer pays us. So that fee that you pay, whether it's 1,000 or 5,000, comes off of your exchange balance overall. So once you've done that, we'll obviously send out a receipt to you confirming that everything's been received. And then we'll speak to our after sales team and put you guys in touch, and you'll speak to one of the team, and they will start choosing a solicitor for you. Or if you've got your own solicitor, even better, you can choose your own solicitor, no problem at all. And you'll start to have to go through what's called the initial documentation, your client care. Now, what you have to do for that is your initial client care will be you proving who you are, essentially. So a copy of your passport, for example, a copy of a utility bill within the last 3 months. It can't be a mobile phone bill, it could be anything else. But something within the last 3 months, a bank statement, an electric bill, just showing your name's on there and where you live. Once you've got that, you send that over to them along with a form saying to that solicitor that you're going to instruct them, and that's your client care completed. What then happens is your solicitor will start to make inquiries. They will start to question the contract from the seller solicitor. So they'll make inquiries. For example, it might say something along the lines of, this is not available for a short-term let, whereas you've negotiated it is. So potentially there's an inquiry to say we want that changed in the contract. So there will be a number of inquiries that can take 2, 3, even 4 weeks and longer to actually come to a conclusion. And once that conclusion is done, your solicitor will then draft a report. And that report is then them simply summarizing the contract. So you've got 70 pages of a contract. What you want is a summary within a couple of pages pointing out all the negatives. They won't point out the positives for it. That's not their job. Their job is to point out all the negatives in that contract. And again, if you can live with those negatives, then no problem at all. You've got a good contract and a good deal. But the reality is they will point out all the negatives and what you have to think about when signing that contract. And they will summarize that in what's called a report. So that's the next step. And if you're happy, you will sign and send that report back. And then once they've done that, they will then send you an exchange statement, and you will then pay the balance. So for example, if it's off plan, you'll pay 15, 20, 25% of the balance. It is typically 25, but you pay that balance and then you exchange at that point. So you pay your balance minus your reservation fee, of course, and then you've exchanged. And then when completion arises, if a completion is now, you may go straight ahead and complete. But if completion arises in 6 months, you'll then be in contact with your solicitor again. And that's when you pay the remaining balance either in cash or with a combination of cash and a mortgage or straight mortgage, however you're going to structure it. And at that point, you collect the keys or you nominate someone to collect the keys for you. So what many of our clients do is they nominate us. We have people in the areas and they pick up the keys and then we start to let it. So how do we go ahead and let it after you've exchanged and completed? Well, it's really straightforward. Is we will, first of all, before anything else, we'll do some snagging. We'll go in, we'll make sure that there's no deficiencies within your property. We'll make sure everything works. We'll take meter readings of everything, and then we'll start to take some pictures and get it let. So what we do is we can also get things furnished for you. If you want us to get a furniture pack in to glam it up, no problem, we can do that. We'll take some pictures for you, we'll get an inventory done, and then we'll get it listed on the market. So we've got a huge number that have listed on the market at the moment and actually under offer and that we're letting, and we're getting really great returns on that. But the reality is once a tenant shows interest, we don't just get them in, we have to do a lot of vetting. They have to go through checks on them. They provide all the documentation, and we have to make sure that the affordability is there. So that gets all done and all vetted by a third party. And once that's all completed, then we can start to make arrangements with getting them in. Of course, you are updated every step of the way. We make sure that you guys are fully aware of what we can let this for, and we make sure that you're fully acceptance of their offer. 2 types of lettings that we've got. We've got Skylet, which is a trademarked arm of our business that does all of our short-term lets, such as Airbnb and Booking.com. And then we've got our traditional lettings, which is simply Flambar Williams Lettings. That does all of our traditional, what they call AST, short hold tenancy lettings. That's our traditional 12-month lettings, as normally you've probably rented in the past. And if you have, you've probably done a traditional AST or a 12-month letting. So we've got 2 arms of our business that deals with all of that. Things to consider is if you're overseas, you have to get back what's called an NRL1 form. This is what's called a non-resident landlord 1 form. If you don't, the reality is that you're going to have tax taken from you at source. We have to take it at source. So we will take that from you. In terms of other things you have to consider is income tax. Are you in a limited company or are you in a personal name? If you're in a personal name, you're going to have to pay income tax on your gross amount. If you're in a limited company, then no, it's going to be on your net amount, but that's going to be corporation tax. Again, we really say to you, get an accountant. We've got contacts with accountants we can put you in touch with, and they will steer you in the right direction. The cost of an accountant, the benefits of that, we feel will far outweigh the actual cost, because they will actually save you a lot of money in the long run moving forward with tax. And again, it's never plain sailing. Anyone that's told you, or any agent that says it's perfect from start to finish, it isn't. There's always bumps in the road, whether that be tenants not paying or tenants moving out, but we mitigate that as much as we can by getting better quality apartments, better quality tenants, do more vetting, and again, we're always on hand. in fact, because it is never plain sailing, the reality is the obstacles you probably don't hear about. We just deal with them. That's our job. So we take care of that for you. And like we said here, we're with you every step of the way, right the way through till sale side. If you want to sell through us, we can do. Again, you don't have to. You can use other tenant management agents, letting agents. There's other good short-term letting agents out there as well. And when you want to sell, again, you don't have to use us either. So there's plenty of options. But overall, we do this day in, day out. We put through a huge amount of deals on a weekly, monthly, yearly basis. And a lot of people are first-time buyers. So we totally get it. One thing that I say to the brokers a lot is, look, put yourself in their shoes. It's very easy to us to say, well, this is what it is. It's very simple, but it's also, very easy to us to get caught in a trap where we just assume that you have the knowledge. So what we want to make sure is if there are any questions that you've got at all, just feel free to ask your broker at any step of the way. So overall, I'm going to now hand over to you guys if there's any questions and answers. What I would say is, if you could subscribe to this, if you're watching this back on YouTube now, and you're watching this webinar back, if you could give it a thumbs up, if you could subscribe to us, it should be in the bottom left-hand corner, I believe. That'd be fantastic. And again, it really helps us with our numbers, but also for you guys, it will keep you abreast of any future webinars that are coming up. Importantly as well, we do have another webinar next month, and it's going to talk about interest rates and what the interest rate rise in December and the imminent interest rates that are coming up now, what they're going to mean for you, for the property market, for the lending market. So that's going to be a great webinar that we will have over the next sort of 3 to 4 weeks or so. So yeah, if you can subscribe, that'll be fantastic. So now, guys, what I'm going to do is I'm going to sort of stop this share, and then we're going to hand over to you. And any questions at all any questions that you have? So let's have a look. I've got one on the chat here. So updates for St Anne Gardens or any other projects, what kind of support do we give to any other projects that may have been delayed because of the pandemic? Good question. So what we have done is we've got a document that we're going to send out by end of play tomorrow. We had to get everyone's authority that we can send them this document. That will have the contact or the regular contact that we're giving the actual developer. We're speaking to them every day. So if there's any projects that have been delayed, because you typically would always get projects delayed with off plan, there's very few. I would say typically 60 to 70% have been delayed for at least 3 months. There are some that get delayed a lot longer, but typically you'll get a good few months delay. That's just the nature of the property market, especially due to COVID, construction quieting down. Then it's picked up. But now the issue that we've got is costs, and the reality is costs have increased. So many developers are a bit reluctant to put a spade in the ground whilst they've got these high costs. But in terms of support, look, we are always at the end of the line. We're with you every step of the way. What we're trying to do with St Anne's is we're trying to get options where we can potentially sell clients out that got in very early and very cheap, so we can sell clients out. But also the document will be uploaded by end of play tomorrow, and you will see the regular contact and the answers that we're getting back from the developer. We're still getting regular answers. They're still promising to get on site, but we want a two-pronged attack. So, for example, if they're not on site in a reasonable time, we've got an exit strategy as well. But yeah, we will always give you full support. Going back to the legal practice that's working on St Anne's. Okay, that's tied in with the same question, sorry. So the legal practice that's working on St Anne's, again, there's a legal practice called Silver Shellings Ash. They were taken over by Fletcher Day. I will get onto Fletcher Day for you and see if they can get back the guy who was dealing with it, a guy called James. He was skiing. I'll be honest, he had a skiing accident. He's now back in work and playing catch up, but I will chase it up, no problem at all. Are there any developers that I would highly recommend or avoid? Heaton Group X1. Guys, typically, if I'm honest, we're pretty reluctant to berate and negate other developers. If we're not recommending them, it's probably because we're not overly keen on them, or maybe we're just not over keen on what they're recommending. I've dealt with X1 before. I've got nothing negative to say about them. We don't deal with them now. There was no issue with them. It was just the ground rent that we couldn't get over because people struggle to get mortgages. But no, as I say, I would never really like to negate other other developers. What I would say is we look to meticulously choose our own developers. We're not perfect. We're not sitting here saying we get everyone 100% right. We don't. We're not perfect, but we will do everything we can to get over any obstacles that do arise. Got here, what would be the disadvantages of having a lease property? And since there are quite a lot of apartment buildings in the UK, will that reduce the value of apartments going forward versus basic supply, freehold, supply and demand? No, a lot of people have this misconception that a leasehold property, there's big disadvantages. There's not. You just have to look behind me. This is all leasehold. Everything you see behind me is leasehold. So the reality is no, there's not major disadvantages with having leasehold. You're probably talking, 4.8, I think it was, or 5 million flats, which are all going to be leasehold. It's something that's been around for years and it's going to continue. There's no major disadvantage. The only time it becomes a disadvantage is if you go below 80 years, it starts to cost a bit more money to get you to increase the leasehold. But moving forward, government have put or looking to put legislation in place, which means you can just automatically get it up to 999 years of lease. Again, one thing that you can do is don't forget, it's not something that the freeholder can choose. If you decide that you want to increase it by 90 years, they can potentially decline the offer that you've made for those 90 years, but it can then go to arbitration. What they cannot do is say, no, we're going to run it down. We're going to run that lease down. They can't do that. The big advantage for me for leasehold is look at the best properties in the UK. They are, over the last 10 years, they have been city centre properties. They've gone up the most, whether it be London, whether it be Manchester, Liverpool, take globally. Where's the, where would you buy? If you were going to wind back 10 years, 20 or 30 years, I can guarantee you would buy a city centre property. If you went back to the 80s, you'd buy in Canary Wharf, all leasehold. You would make an absolute fortune. The majority of London is leasehold property. So no, I really don't agree with the disadvantages of leasehold properties. The reality is that even with freehold properties, you've still got to take care of the land around you, take care of the garden. You've got to maintain the external property. It's the same with leasehold. You're just getting someone else to do it for you. Do we cover all areas of the UK? Yes, we do. We cover all areas of the UK. Typically, though, at the moment, we're focusing, as I say, on Manchester, Liverpool, Birmingham, but we have down south as well. If something comes up down south, which is ideal from an investment perspective, 100% we're moving it. We're not saying all of the south doesn't make a great investment. There are some pockets which make fantastic investment. We've got great opportunities down south, half an hour from London, in Surrey, in close to Heathrow as well, which make great investments. But again, typically we're finding the majority are up north. But yes, we do cover all areas of the UK. Someone said, can I speak my questions? No, there's no facility here. Sorry, there was on the old bit of software that we use, but on Zoom, no. I do apologise. It's all typed, so I apologise. So let's go over to the chat. We've got another one here, guys. Let's have a look. Two sets, guys. So that's a couple of duplicate questions here. How much should you consider the service charge when calculating the value of an investment? That's a really good question. So depends on the area. So for example, if you were looking in Manchester, depending on the quality of the development, for example, does it have a gym? Does it not? Does it have a steam room, sauna, swimming pool? All things like that have to be taken into consideration. But I'll be looking anywhere from around about £2 to £3 service charge. The more facilities it's got, the more you're going to pay. So if you're going to have to start talking about, we've got one that has swimming pools, saunas, steam rooms, you're probably looking at £4.5 service charge. That's probably only going to increase as these things get a little bit more wear and tear. So typically what I would say is, from an investment perspective, don't be fooled by a lot of these extracurricular, things like gymnasiums and things like that are good, because at the start they are, but moving forward, they start to cost a little bit. As we then head to secondary cities, I'd be looking at, getting under that £2 mark. And as we head into London, you could be looking at, £6-7 a square foot. So, it's a good question. You're basically looking for the best kind of service charge, not to eat into your profits. It's as straightforward as that. But every property will be slightly different. outside of city centre locations, are there any locations that are in around Liverpool, Manchester, Birmingham, good to look at for longer term lets? There are. My biggest concern with as we head out, and by outside, I'm not talking about 5-minute walk, 10-minute walk. I'm talking about getting out to the suburbs of those areas. Is when the property market falls, which it will do. There's no getting around it. It will get to a point where the interest rate goes up so much that people start to think twice about buy-to-lets. They think twice about making that offer over the market price. They start to make the offer under the market price. So at some point, it will start to fall back. I don't think it's going to be anytime soon. We're looking maybe 2, 3, 4 years away. But as we get out of those locations, what tends to happen is you look at different demographics. You're looking at families renting in those suburbs rather than a younger demographic. So when you have families renting in those areas, they really ideally want to buy it. So when the property market falls and the price gets cheaper, well, they'll stop renting and they'll start buying because they can now afford it. Whereas typically in city centres, you don't have that because one, they're higher price, so they can't afford it. But secondly, many young people, they don't buy in the city centres. They want to live here, have the fun, go out, great social scene. But when they meet someone, then they head out to the suburbs. So that's why we typically always recommend the city centres. I'm looking to buy in the UK market, live in Guernsey, Channel Islands. My business strategy sees me renting a property to live in personally on the island for the next 5 years, whilst building a deposit via surplus rental income, and hopefully buy capital appreciation. Will not owning a home make it hard for me to acquire an expat mortgage? I will be retaining substantial cash. Right. Okay. So what you're basically asking there is you're saying that you're looking to buy in the UK market. You live in Guernsey. What you're looking to do is renting a property to live in whilst building a deposit and surplus rental income to then go and buy something. Will not making a home make it harder to require an expat mortgage? Okay, so if you're talking about a buy-to-let mortgage here, it is slightly more difficult to get a buy-to-let mortgage if you don't own your own home. Yes, but what I would say is your best bet is to speak to a mortgage broker, because whereas my knowledge of the mortgage market will be limited to what we've done, their knowledge will be a lot wider because that's their speciality. Their knowledge will be a lot wider, and they will probably have faced this before. So no problem at all. If you send me an email, what I'm going to do is I'm going to put my email address in here, and I'm going to see if I can send it to everyone. And if I can, then feel free to send me an email. And then any specific questions, then you guys can ask. No problem at all. Let's get back to that. Are there any areas still in London that we think have a good buy-to-let potential or growth and yield? Yeah, I would. There are places, whether you could call them London, I don't know. But there's, for example, what's been popular recently, Barking, Dagenham, those kind of areas where they're looking to spend a bit of money. We've got places in Hounslow, which is on the Piccadilly line, which has made a really good buy-to-let. We've got places in Surrey. What I would personally do is, rather than looking in London, look at things like that about maybe 30 minutes away. So, for example, the one that we've got in Surrey, really good pricing, probably pretty similar to Manchester, but you're in London Bridge within 30 minutes. So things like that is probably what I'd be looking at, rather than specifically saying I want central London. Can you buy a property on a buy-to-let mortgage and rent it out to a family member? Yeah, you can rent it out to typically who you want. There might be certain things, stipulations in your mortgage, but theoretically, if you're renting it out to a family member and they're paying for it, and it's a normal buy-to-let, well, yeah, no problem. Regarding St Anne's, it looks like Flambar Williams stepping away from the developers. Are you going to get a document regarding this? How likely is it? Right, so what we're looking to do is, as I said, with St Anne's, we're looking to have a two-pronged attack. One is for them, obviously, we keep pushing for them to get on site. And the second is we're going to look to sell units for those who've got in a couple of years ago. There are people who have bought recently, and there's a number of agents who are still actively marketing St Anne's, and a number of deals are going through. They're doing extremely well. But for those who have bought early, then we know that because obviously they're looking to get on site over the next couple of weeks. When I spoke to the guys yesterday, then the reality is people that have bought a couple of years ago who got a big discount, they've got chances of turning around and making some good gains. But again, in regards to us stepping back, no, we're not stepping back from it at all. It's just that we understand that people that are bought really early on and got those higher, value departments, or those really well valued apartments. They're the people that are potentially looking to sell, because obviously if you've got yours at 106 and they're now going at 130 2 years later, there's some potential gains to be had. Let's have a look. Okay, guys, I think we've covered it. Right, well, look, fantastic, guys. I really hope it. I've got one hand up. Sorry, guys. Oh, okay, that's the same question. Okay, yeah. So, guys, I hope you have a lovely rest of the week and a good month. Anything you need, feel free to email me directly. As I say, don't forget our next webinar. Subscribe to this. Our next webinar is going to be on the interest rate and what it means for you. And I look forward to speaking to you all soon. Take care. Bye-bye.